Hello and welcome to the Providence Investment Update for September 2021. My name is Michael Ogg. I'm a Director and Senior Advisor at Providence. I'm joined today as always by Grant Patterson, CIO and Founder of Providence. Welcome, Grant.
Thanks, Mike.
Grant, I thought I'd start as always with the title of the Global Outlook and Strategy, which is Seismic Shifts. Please explain to me what you mean by these seismic shifts.
Well, thanks, Mike. Yes, in regards to the seismic shifts, we think there's some very big macro changes going on. And number one is that we've started to see, for the first time in decades, a pickup in inflation. In the US for the September quarter, inflation was up 5.5% for the 12 months year on year end of September. So that's quite a big change. Now, whether that's transitory and it's just due to supply bottlenecks or whatever, not quite sure. But, you know, there is some real input price pressures coming through, and the least, not the least being energy prices, which have shot up. You've also got a bit of a change in the workplace. I'd call it the Great Resignation. We're starting to see around the globe a real change in the way people wish to work, and also a lot of workers retiring early. So, you know, in the States, for example, there's 7 million people unemployed, but there's 11 million job openings. So we think that sort of change is going to see an upward bias to wage costs, which would undermine somewhat corporate earnings. And of course, with interest rates, risk assets have had 40 years of a tailwind with declining interest rates, declining bond rates. That looks to us to be starting to turn now, so you won't have that tailwind. On a macro or geopolitical level, in China, there's been a real change in rhetoric, both at a domestic level and also on international engagement, which has been well publicised. So, you know, China, that was a great supporter of the globe, where manufacturing was outsourced to, is now having a change of rhetoric, if you like, both, as I say, at a domestic level, and we've seen that in the property market, trying to cool that, plus in regards to international relationships. And then the last bit is, after many decades of the substantial inequality of wealth and no wage costs, you know, there's been a rise, if you like, in populism or unrest at a social level, notwithstanding what we saw at Capitol Hill, the storming of Capitol Hill. And so I think, you know, that's something that we've got to be quite wary of, or aware of, I should say, rather than wary. And so I just wonder whether we're starting to see the balance shift back towards the workers and the workforce. And in the States, you've seen, you know, family tax breaks, you've seen infrastructure spending coming through, and so the Lessons of History book by Will and Aria Durant points that, you know, when there's a shift in the redistribution of wealth, it either comes through revolution or comes through government policy, and perhaps we're seeing a little bit of both.
And where does that leave us, though, with in regards to financial markets?
Well, look, we're still positive, but we're rather protective. We've had a very good run over the last few years. I mean, the least resistance for risk assets is up, because central banks are still going to be, you know, putting the foot on, you know, interest rates spiking, and there's no other real alternative, particularly in trying to gather any income. So we're still positive, but we're just aware of the change, the seismic shift. So, you know, we want to make sure we've got inflation protection in the portfolio. We want to make sure we've got a lot of diversification to cover all the various potential outcomes. I mean, the thing to remember is there's so many distortions in the financial and economic system through the efforts of the central banks and governments over the last few years that it's impossible to accurately understand which way this will all go. So the implications are being diversified, having some protection in your portfolios, but making sure you stay in quality assets. We have a value bias. We want to make sure we've got some protection against inflation, and stick with quality and active management. And I think that will get the portfolios through.
Grant, are there enough investment opportunities to choose from in this kind of environment?
Mike, there's an enormous amount of product coming through because of all the surplus capital that's around. I mean, Providence, for example, you know, over the last 12 months, you know, we've seen 64 new investment opportunities. We've had meetings with 260 fund managers after the last 12 months, but we only chose to invest in 15 opportunities. So there's no shortage of product, whether it be through managed funds, hedge funds, property syndications, private equity, venture capital. The list just goes on and on. Crypto ETFs, like there's plenty. The real thing, I think, at this point of the cycle is remaining very disciplined and being careful not to style drift. Understand the risk that you're taking and are you getting paid for the risk in certain assets.
Can you also just walk us through the various asset classes that are out there?
Yeah, sure. So within equities, what's an index anymore in a sense when we say is the index cheap or expensive? In the States, for example, the top 10 stocks account for 30% of the market cap. So when we start saying is the US market going up or down, you have to have a view on those 10 stocks. So there's been a fair bit of distortion there. So within equities, we believe that our preference is for value biased equities. Non-US, we have a preference to outside the US because on valuation grounds. We prefer active managers so we don't get too concentrated in the top stocks. And also we're looking at thematics. So, decarbonisation, renewables, artificial intelligence, automation, those sort of health tech, those sort of areas are big themes, and so we tend to use fund managers that look at the thematics of companies rather than just an index. Within fixed income, we're very wary of duration risk as inflation may stay more elevated than people are thinking and bond markets continue to rise. Remember that a 1% increase in the bond rate is a 9% decline in the capital value for a 10-year bond. So we're wary of that. We're also wary in credit. Credit spreads have come in very narrow. They're very tight. Covenants are pretty light at the moment as people are chasing yield, and we're just not convinced you're getting paid for the risk in a lot of the credit areas. So we're cautious there. So where are we generating income? We do like loans, senior secured, fully secured, first mortgage loans. We think there's a good opportunity there. We do have some bonds in the portfolio, but that's only to protect the portfolio and enable us to have the risk assets to give us the performance. And of course, we've got some cash in the portfolios just to have the liquidity if we get a correction. Within the other asset classes, property, in the direct property space, we're very much focused on the niche sectors. In commercial property for us at the moment, there's not enough transparency to what that looks like as the workforce comes back and what the vacancy rates might be. We're quite attracted to retail, shopping centres at the moment, and industrial. The cap rates are so tight on industrial, we're not there. So what do we like? We like regional hospitality assets where you're getting sort of 7 to 8% type income yields from those sort of assets. Specialist disability housing looks very interesting to us. Social housing, also very interesting to us. And we've also got an exposure to agriculture, which gives us some inflation risk as well, or protection, I should say. So that's where we are in property. And in alternatives, we're really just looking at long, short, market neutral type funds. Gold certainly makes part of our alternative space because of the protection for portfolios. So, that's sort of our current stance. And as I mentioned, we're positive, but we're just protective of the recent gains that we've had.
So Grant, what sort of implications does this have for asset allocation?
Well, I think it's changing. I don't think the basic vanilla 60-40 portfolio is going to give you the returns that we've been used to over the last 20 years that we've been in operation. So what it really means is that you need to keep an open mind. I think real assets are very important, that have got good, strong cash flows, that are non-correlated to the equity markets, and just be aware of those sort of risks, remaining very, very diversified.
Grant, thank you for that. And is there any update on Providence?
Well, the office is back open, but it's optional at this stage for all the staff whether they come back now or into next year. Double vaccinations are a minimum for everyone to come back into the office. James Smith down in Melbourne, after 262 days, is now tasting the first parts of freedom, and he's very excited to get out to see his clients again, as all Victorians would be. So that's happening. The party for our 20th year, that was going to be our 21st year, that now looks like our 22nd year, is in planning for next year. So we look forward to that. All the staff are well, and we're just looking forward to re-engaging with our clients when we can all get back together.
Grant, thank you very much. Thank you very much for your time as always.
Pleasure.
And thank you for watching. I hope you enjoyed the presentation. If you do have any questions or queries, please don't hesitate to give us a call. We'd be delighted to hear from you. Thank you very much.